Today's lesson is lesson 15.2, Adjusting Merchandise Inventory and Interest Receivable. Our learning objectives for today are adjusting the merchandise inventory and then adjusting the interest receivable. When recording and adjusting an entry for a merchandise inventory, the amount of inventory on hand at the beginning of the fiscal period is called the beginning inventory. During the period, merchandise is often purchased or merchandise is sold, so that can fluctuate the inventory. To determine how much merchandise remains in the inventory at the end of the period, you must conduct a physical inventory or actually count. The actual count of the merchandise at the end of the fiscal period is called the ending inventory. When recording and adjusting entry, you're going to take into account the beginning and the ending balance of the inventory. So here we have a sample of what a journal entry would look like for merchandise inventory. As you can see, they took the difference between the beginning and ending inventory and journalized that amount. So for December 31st, the journal entry is $56.48.44, and it is a debit to the income summary and a credit to merchandise inventory, because again, when we sell inventory, we receive income. Journalizing the adjusting entry for interest receivable. Interest is just earned but not yet received. It's called accrued interest income. So what that means is that something was provided on credit, and at the time that you journalize it, you journalize the sale, but you have not journalized the additional interest income. So the two accounts here are interest receivable, receiving the interest, and interest income, accounting for the additional money that is going to be added to your revenue. Again, we're going to look at the journal entry. So we have our interest that comes in, and we're making an adjusting entry because we're going to increase our income from interest. So interest receivable gets debited the amount, and interest income gets credited the amount. So how is the amount of merchandise inventory on hand at the fiscal year determined? The best way and the only real way you can do it is by actually physically conducting an inventory count. What adjusting entry is recorded when the ending merchandise inventory is greater than the beginning? You would switch. You would do a debit to merchandise inventory and a credit to income summary. How often is revenue earned on an outstanding note receivable? Interest is earned daily. What types of accounts are increased by recording an adjusted entry for accrued revenue? The adjusting entry for accrued revenue increases a revenue account, so it's a credit. And if you're going to increase account receivable, that would be a debit. So let's go ahead and get into our account. So for today, we're going to work on two journal entries. The first journal entry is from a physical count of merchandise inventory. The December 31st balance is determined to be $96,471.25. It says journalize the adjusting entry for merchandise inventory. A single note receivable is outstanding on December 31st. So this is our second entry. The 90-day 8% note was signed on November 22nd. Journalize the adjusting entry. So for today's assignment, we'll be journalizing two entries. A physical count of merchandise inventory, and then the interest receivable adjustment. In order to calculate the amount that we're going to be journalizing for our adjustment, we need to go to our unadjusted trial balance to check what was our beginning inventory, and we need to find the difference between our ending inventory. So we're going to go to our unadjusted balance, and our merchandise inventory at the beginning of the year was $94,845.31. So we're going to find the difference. So the first thing we're going to do is bring up our calculator. So we're going to put the ending inventory amount, which is $96,471.25, and we're going to subtract the balance that's on our adjusted trial balance. Which is $94,845.31. So the amount that we're going to journalize is $1625.94. I'm going to come to my journal on 31st. The first account is merchandise inventory. And the amount is $1625.94. The second one is income summary. And still $1625. The second journal entry that we're going to be doing is going to be the interest received on the note. So we have a 90-day note, 8% interest was signed on November 22nd. So we need to journalize the adjusting entry for this interest. So we're going to clear out our calculator. First thing we need to do is figure out the amount. In order to calculate the amount of interest that we're going to journalize, we have to figure out how many days we've had this note. So the note was signed on November 22nd. So the first thing we do is we figure out how many days are in November. We know that November has 30 days. We started on the 22nd, so we're going to subtract and get. So we used 8 days of November. Now we're originating this journal entry on December 31st. So that means that we're taking all 31 days out of December. So this note has existed for 31 plus 8 days. So we're actually calculating the interest for 39 days. In order to do that, we're going to go to the calculator. We're going to put the loan amount, which was the note receivable for $8,000, times the interest, so times 0.08, times the number of days, times 39, and we're going to divide it by the average number of days per year that we use in finance, which is 360. So we're actually going to journalize interest for $69, and since the third decimal is not greater than 5, everything drops off. So this will be $69.33. So I'm going to come here to my journal entry, is interest receivable. For $69.33, and then interest income. Also for $69.33. And that's what you're going to be working on today in 15-2.